Welcome back, traders. We're less than an hour away from the cash open, and we just had some eco data hit the market here. Some housing data just got released. I want to take a look at some of the numbers. This is actually a two-part number. We get the building starts and our housing starts and building permits in this one. Take a look here, guys, at the starts, which came in well above expected and also well above prior. You can see the permits also beat expectations as well. This is going to be a bit of a ray of hope after yesterday's dismal housing market index, which came in at 64, well below consensus levels. Don't forget, we also have existing home sales coming out a little bit later on this week. But I want to head on out to the floor of the CME Group, where we have Bob Iaccino, the founder and chief strategist at Pat Trading Partners. He's standing by. Bob, it's good to have you with us. Thanks for taking time out of your day to be with us here this morning. I want to begin with what you're expecting we'll get tomorrow from the FOMC and Fed Chair Jerome Powell.
Yeah, I mean, obviously we're not getting a rate cut tomorrow. I think that's fairly obvious to most market watchers. That's just too quick of a pivot for the Fed in terms of rate policy. Not necessarily rate stance, but actual rate policy. I don't expect any change in the slide in asset purchase removal or the quantitative tightening. I don't expect them to change that yet either. But what I do expect is a continued sort of move from the rhetoric standpoint toward a stance of, if this continues, we will be ready to do something this year. I don't know exactly how Jay Powell is going to phrase that. I haven't seen him speak enough times to kind of get an idea of that, but he has a reason. He has a reason where he could do this and not look political, in my opinion. There's been a lot of talk about the Fed's credibility and them looking political. You know, I think when you look at it from the perspective of whether Jay Powell is going to be moved on presidential tweets or statements in press conferences or statements by anyone outside of the president but within the administration, I think that's a little silly. When you look at the data, okay, if Jerome Powell was going to be moved by the president, he would have moved already. But if you look at the data, if you include the data we got today, anything with a high to moderate value to the overall market, right? Not a low value like Empire State, to me, doesn't matter that much. It's not a big enough manufacturing hub at this point. You're talking about mostly upstate New York. We've gotten 33 data points for the month of June, including this morning. And you've got 21 data points that disappointed, 11 that exceeded, and then one that was basically in line with expectations. So a full 2/3 of the data points so far have been negative in terms of the U.S. economy. Now, we're not even looking at it internationally. It's worse in China and it's worse in Europe. So there is a reason to potentially say that if data continues on this path, we're going to cut rates.
Bob, there definitely is some focus this morning in terms of Mario Draghi and the ECB. Before we get into some of the specific comments, if the Fed cuts, and not necessarily this week, does the ECB have to as well? Do lower rates here in the U.S. force the ECB's hand as well?
Yes, and I think that that's what Mario Draghi was referring to today when he basically said that we will actually be more accommodative than we've been. The last ECB meeting was surprisingly hawkish. And by hawkish, I mean they said we're not moving rates, basically. They actually extended their outlook of keeping rates the same by about 6 months, said that they expect inflation to outperform in 2019 and underperform in 2020. And Draghi's comments this morning were essentially, look, if we're wrong about that, we'll move quickly and we have the room to move. So that to me was a direct response. And I said this at the time, Ben, I think I was actually on with you. The thing that Draghi did by surprising the market was basically go against Australia's central bank, India's central bank, to a certain degree the U.S., China with all the stimulus they've been doing on the currency side of things. When global central banks are being stimulative, the lone standing central bank, which was the ECB, somehow being status quo or even slightly hawkish, isn't going to fly. It isn't going to stay the case.
Yeah. So in theory, though, when you think about it, the ECB to lower, wouldn't it be counterproductive? I mean, at least in terms of efforts to reach our inflation targets, you would think, again, a lower currency gives them more buying power and reduces some of those inflationary pressures.
Well, I mean, more currency in the market would theoretically get people to spend more. Therefore, you have more dollars chasing fewer goods and would theoretically spark inflation. But you know, Ben, and I think this is what you're commenting on, that hasn't worked. It really hasn't. I mean, we've had easy money since 2008, 2009. and no one's been able to get their inflation target up. And I believe that's because of the structural deflationary economy that we're currently in. I mean, when was the last time you bought something without a discount, without a coupon code, where you were able to go online and buy things and find the cheapest price? There's even apps like Honey, for example, that automatically adds coupon codes to existing retailers you may be shopping at. People starting to look at Walmart, which is often online at least cheaper than Amazon. It's competitive to Amazon. Walmart's online business is growing. These stocks are responding as well. So we're in a structural deflationary economy. So the idea that easy money somehow trickling down to the consumer, where they're just going to rush out and try and compete without looking for that better price, it's too easy to look for the better price now.
Yeah, you know, Draghi, one of the comments that stood out is he said, in the absence of improvement such that the sustained return of inflation to our aim is threatened, additional stimulus will be required. I wonder if he's talking TROs, the extended loans, or potentially, again, kind of getting back to what we were talking about, the potential for a rate cut.
Yeah, I think he is talking about the loans, because from his perspective, that's the easiest first tool to kind of turn around and not necessarily affect what's been negative rates in the EU, negative real rates for quite a long time. Again, we're talking, the definition of inflation has changed since I was in school. I mean, in economics, inflation just used to mean an expansion of the monetary supply. It had nothing to do with price. The natural offset of that was that price went up. Because if there's more money, you can't have more goods as quick as you can have more money, right? So if they put more money into the economy, chasing fewer goods, the prices go up naturally. That's broken down. Now, it's going to be really difficult to change the definition back. I mean, just think about the word inflation. It's an inflating of the monetary supply. That's what it was. It's no longer that. It means prices now. And prices going higher, I mean, when does that happen? And that's why it's funny, the tariffs and the trade war, while I don't agree with them as a tool, especially not a tool for non-economic problems like the border concerns. That was just a nightmare. But if you're going to use tariffs, when's the best time to perhaps put a little pressure on the American consumer, which is where those tariffs trickle down to? When there's no inflation.
Yeah.
So the consumer hasn't felt it yet, and it's certainly not showing up in the numbers. We just had disappointing CPI in the US and in the EU a couple of weeks before that.
Yeah. Bob, I've got one more question for you. I'm curious in terms of, we covered the ECB, we talked about the expectations for the Fed, but in addition to that, we have the Bank of Japan as well. What are you going to be looking for? Just comments related to stimulus?
Well, it's funny, Kuroda about 6 months ago said, we're going to let it go. Nothing's worked, so we're going to do nothing. Recent comments, he spun that around as well. And again, that's this fear by central bankers of not reacting. I'm not here to tell anyone if that's the right policy or the wrong policy based on economic theory. I'm here to tell you that that's going to move the markets. And right now, again, it seems like we're potentially starting a new race to the bottom in the currencies like we had in 2010.
All right, it gives us something to watch as well. The yen's been holding up above 9,300, currently trading up on the day by about 1/3%. We'll keep a close eye on this and other central bank activity. Hey, Bob, really appreciate you joining us for a look at the currencies and the upcoming Fed meeting and some of the influences that are playing here in terms of price activity. Traders, that's Bob Iaccino. He's the chief strategist at Path Trading Partners. Now in a transition from the currencies on